Being self-employed means paying your taxes. What does this involve? What are some tips to keep in mind? Don't get yourself into a jam by being stupid. Today we're going to cover all the things you need to do as a real estate agent to pay your taxes because you are self-employed. Hey, it's Mark here with the Hiller Group, brokered by eXp Realty. My team and I have you covered here on the beautiful Florida Panhandle from Pensacola all the way through Panama City, where our team has been fortunate enough to serve over 1,350 families in the past 10 years alone. Look, as a high-producing real estate agent, understanding and managing your taxes is crucial to maintaining financial health and ensuring that you have compliance with the tax laws. The nature of your work often involves various sources of income and deductible expenses. This requires diligent record keeping and strategic planning. Here are some of the best practices for high income earners and key do's and don'ts to help you navigate the tax landscape effectively. First up, don't be cheap. Hire a professional accountant. Why? A professional accountant, preferably one with experience in real estate, can provide invaluable guidance on tax planning, deductions, and compliance. What's the benefit? They help maximize your deductions, avoid mistakes, and ensure that you are meeting all your tax obligations. You also want to make sure you're keeping detailed records. Accurate and detailed records of your income expenses and business activity are essential for tax reporting and audits. This helps in identifying deductible expenses, supporting tax returns, and ensuring their accuracy. You also need to make sure you fully understand what are the deductible expenses. Knowing what expenses are deductible can significantly reduce your taxable income. For example, I was able to write off our golf cart that we have our advertisement on the side because we're driving around our community advertising that we are the local realtor. Some common deductions as office supplies, marketing costs, business travel, professional development, home office expenses, and commissions paid to other agents, gas for your car, logo to tire and swag, business lunches, etc. Those are all things you can write off and save money on your taxes. This benefit reduces your taxable income and increases overall profit. You always want to make sure that you're separating your personal finances and your business finances. Mixing personal and business finances can complicate your tax return and your situation at the end of the year. This will also increase the risk of errors. Keeping your personal and your business separate simplifies record keeping and ensures clarity in your financial reporting. Another thing you need to plan for is quarterly taxes. Why? As an independent contractor, you should pay your estimated taxes quarterly. This avoids any underpayment penalties and ensures that your cash flow management throughout the year is accurate. Next up, you want to utilize tax-advantaged retirement accounts. Why? Contributions to retirement accounts like your SEP IRA, your solo 401k, and simple IRAs can be tax deductible. This will reduce your taxable income and secures your financial future. Also, please stay updated on all the tax laws. Tax laws can change, impacting deductions, credits, and overall tax strategy from year to year. This is why it's important to have someone in your corner so you can focus on selling and they can focus on doing your taxes. This ensures compliance and takes advantage of any new opportunities for tax savings. Now we're going to jump in some of the do's and don'ts of taxes for real estate agents. Do track all of your income to ensure you report all forms of income, including commissions, bonuses, and referral fees. Set aside a portion of your income regularly to cover your tax obligations. Maintain receipts for all your deductible expenses as proof in case of an audit. Here's one hack that I do. I've created a Google Drive folder, and I have the Google Drive app right on my phone. As soon as I get done having a business lunch, I take a picture with the scanner app on the Google Drive app, Take the picture and save it directly to a folder that I have labeled by month for all my business tax receipts. I've then given my accountant access to that folder, and now all he has to do is log in there and grab the receipts directly from the folder each month. This makes it very easy. You don't have to lug the receipts around, stick them in your pocket. Oh my gosh, what did I do? I washed the last receipt. I used to save every receipt when I first started in real estate. And oh my gosh, I was sending a package this thick to my accountant after a couple years. It was crazy. So think about some other hacks you can do to help yourself save time and energy when saving those receipts. Tools like QuickBooks or FreshBooks can help streamline the financial tracking and reporting. My accountant and I also use QuickBooks. So he does my taxes, but he also runs my books on a monthly basis. So I have a monthly P&L statement, profit and loss, so I can see exactly the health of my business on a monthly basis. Regular consultations with a tax advisor can help you stay on top of your tax situation and plan for the future. When my business started really taking off a couple years ago, guess what happened? I found myself talking to my accountant more and more often because we were being strategic about some of the purchases we made for the business to make sure that they were going to be tax deductible or if they weren't. So make sure you are staying in contact with your accountant. Some of the don'ts. Don't mix your finances. Avoid using personal accounts and business accounts. Don't ignore deadlines. Missing tax deadlines can result in penalties and interest charges. Why pay extra fees if you don't really have to? Be thorough in identifying and claiming all eligible deductions. Use accurate calculations for estimated taxes rather than just guessing. Poor record keeping can lead to disallowed deductions and complications in case of an audit. As a high-producing real estate agent, you can benefit significantly from various high-dollar tax write-offs. These deductions can help lower your taxable income and increase your overall profitability. Here are some of the most significant tax write-offs you should be aware of. Your vehicle expenses and mileage deduction. Track your business-related mileage. Alternatively, you can deduct actual expenses, including gas, maintenance, insurance, and depreciation. The tax advantage for vehicles over 14,000 pounds, commonly utilized under Section 179 of the IRS tax code, is not currently facing an end date. Home office deduction eligibility. To qualify your home office, you must be the principal place of business and use it regularly and exclusively for business purposes. You can also deduct a portion of your mortgage, interest, rent, utilities, property taxes, maintenance, and insurance based on the square footage of your home office relative to your home. Costs for online ads, print ads, business cards, flyers, signs, professional photography, and social media campaigns are all tax deductible. These expenses can be substantial, especially if you invest heavily in marketing to attract new clients. Fees for professional services such as accountants, attorneys, business consultants, membership dues for professional organizations like NAR and your local MLS are also tax deductible. Any continuing educations, seminars, certifications, coaching fees, travel accommodations, expenses related to attending these events can also be deducted on your taxes. This is one of the reasons we travel a lot to real estate events, because that ends up being a tax deductible cost, but also at the same time gives you a little R&R and get away from the office for a little bit. The cost of computers, tablets, smartphones, cameras, smartwatches, any computer software that has to do with your business, and any technology are all essential for running your business. These include any depreciation of very high cost items over time. As we mentioned earlier, Section 179 of the tax code allows for immediate expensing of certain equipment and purchases up to a specified limit, which can be advantageous for higher dollar items. If you rent office space outside of your home, you can deduct the rent, utilities, and maintenance costs. Co-working space memberships can also be deductible. Meals with clients, open houses, and other client-related entertainment expenses can also be written off. One side note, only 50% of the food costs are typically deductible. If you are self-employed and not eligible for employer-subsidized health insurance, you can deduct the premiums for yourself, your spouse, and your dependents. The travel expenses for business purposes, including airfare, hotels, your meals, 50%, and your transportation are all tax deductible. This is particularly relevant if you attend conferences, meet clients, or show properties in different locations. Commissions paid to other agents or referral fees are deducted as business expenses as well. If you own rental properties, you can depreciate the cost of the property over time, providing a significant annual deduction. Premiums for business insurance policies, including errors and omissions, E&O, liability insurance, and property insurance are all tax deductible. By understanding and utilizing these high-dollar tax write-offs, you can significantly reduce your taxable income and improve your financial standing as a high-producing real estate agent. Effective tax management is critical for high-producing agents by adhering to these best practices, such as keeping detailed reports, understanding deductible expenses, and consulting with tax professionals. You can optimize your tax situation and focus on growing your business. Remember, proactive tax planning and compliance are essential for maintaining financial health and ensuring long-term success in your real estate business. Hope you found this video helpful. Hit the like and subscribe button down below, and we'll see you on the next one.